Okay, so let's talk about Pfizer. It's a company pretty much everyone on the planet knows now, thanks to the pandemic. But here's the thing. While the name became famous, its stock has been telling a completely different and, frankly, a much tougher story.
And that brings us to the big question we're tackling in this explainer. I mean, after hitting these unbelievable highs, the stock has come crashing back down. So what's the deal? Is this a golden opportunity to snap up a pharma giant on sale, or is it one of those classic value traps?
And wow, this chart right here just says it all, doesn't it? While the rest of the market, that's VOO, has been chugging along, Pfizer's stock, PFE, has been going in the complete opposite direction. So we're going to break down both sides of this puzzle, the good and the bad, to figure out what's really going on here. To really get what's happening with Pfizer, you've got to look beyond the pandemic boom. The company is, without a doubt, at a massive turning point.
Now, what's so fascinating here is the sheer visual whiplash you get. I mean, look at that. On the left, you see revenue just soaring past $100 billion in 2022. The chart on the right, for net income, tells the exact same story. But then, look at 2023. A cliff, a dramatic drop. This is the post-COVID hangover, and it's exactly why investors are so split.
All right, so after seeing a drop like that, you might be thinking, why in the world would anyone be optimistic? Fair question. So let's dive into the bull case. This is the argument for why Pfizer's best days might actually still be ahead.
$43 billion. Just let that number sink in for a second. It's an absolutely massive figure, and it represents Pfizer's single biggest bet on its own future. So, what was it for? That $43 billion was the price to buy Seagen, a real leader in cutting-edge cancer treatments. Now, this wasn't just some random purchase. It was a huge, strategic move to become a powerhouse in oncology. And you have to understand, oncology is one of the most important and profitable areas in medicine, especially with an aging population.
And even with that eye-watering price tag, Pfizer CEO Albert Bourla has been very clear that this was a carefully calculated move. This quote really hammers home their focus on smart, disciplined growth, not just spending money for the sake of it.
So the takeaway for the bulls is this. Pfizer is actively building its next chapter. Seagen is a huge piece of that, but it's not the only one. They're pouring about $11 billion a year into research and development. Their cancer drug pipeline is growing, and new drugs are getting approved. And hey, for investors who like income, that 6.3% dividend yield is pretty sweet. It basically means you get paid to wait for this whole growth story to unfold. And on top of all that, you have the valuation argument. A company's price-to-earnings ratio, or PE, is a quick way to see how much investors are willing to pay for it. And as you can see, Pfizer's PE is way lower than the industry average. Same story for its price-to-sales ratio. By these classic measures, the stock looks, well, objectively cheap.
But as you know, cheap can always get cheaper. So let's flip the coin and look at the bear case. This is the other side of the story, the really big headwinds that could stop a comeback in its tracks.
The biggest shadow hanging over Pfizer has a name, and it sends a shiver down the spine of pharmaceutical investors, the patent cliff. This is probably the single biggest threat to their future. And this timeline, man, it just lays it all out. By 2027, two of their massive cancer drugs, Ibrance and Xtandi, lose their patent protection. And once that happens, cheaper generic versions can flood the market, and the revenue from those blockbuster drugs can just fall off a cliff. It's a real race against time for their scientists to find the next big thing. So yeah, the patent cliff is risk number one, but it's definitely not alone. Analysts are worried about a few other major things. You've got political pressure to lower drug prices, the simple fact that R&D is super expensive and often fails, the undeniable end of the COVID money train, and of course, higher interest rates that make giant deals like the Seagen one much more costly.
Okay, so we've got a strong bull case based on future growth and a cheap valuation, and an equally strong bear case based on patents and other risks. So how do the pros on Wall Street make sense of all this?
Well, when you boil it all down, the consensus recommendation from analysts often lands right in the middle, a hold or maybe a cautious buy. And that tells you everything you need to know, right? It's not a screaming sell, but it's not a table-pounding buy either. It signals that there's potential, but it comes with some serious strings attached. To really understand why they're so on the fence, we need to quickly talk about a key tool they use. It's called a discounted cash flow analysis, or DCF. Now that sounds complicated, but the idea is simple. It's just a way to figure out what a stock should be worth today based on all the cash the company is expected to make in the future.
And this is where it gets absolutely fascinating. On the left, you see the stock's actual price at the time of this report, just under 27 bucks. But on the right, the analyst's DCF model, it implies the stock should be worth almost $82 a share. That gap between today's reality and the theoretical value is just enormous. It's the heart of the entire debate.
This chart puts it all together beautifully. You've got the low current price, that sky-high theoretical value from the DCF, and then right in the middle, you have the analyst's official price target of about $31. That target is their conservative middle ground. It says, yeah, we see the huge long-term potential, but we also respect the very real risks that are here right now. So where does all this leave Pfizer? What is the actual game plan to try and close that huge gap between where the stock is and where it could be? The strategy really boils down to these 4 key things. First, they have to make that Seagen deal work. No excuses. Second, that R&D pipeline absolutely must deliver new blockbuster drugs to fill the revenue holes. Third, they've got to play the political game and navigate all the pressure on drug pricing. And finally, they just have to execute flawlessly. The company calls this operational excellence, which is really just corporate speak for making sure every single part of the business runs like a well-oiled machine.
Ultimately, it all comes down to this. Pfizer is making enormous, multi-billion-dollar bets on science and innovation, hoping to outrun that patent cliff and all the other risks. The question for every investor and for the company itself is simple. Will those big bets be big enough to work?